Well, there you have it. The Bank of Canada cut an additional 0.25% on Wednesday, ultimately opening the door for potential rate cuts to come, both at the next couple meetings to end off 2025. In this week's episode, I really want to focus in on what do these rate cuts mean for Canadians? What did the overall sentiment look like at the most recent press conference? And if you're a mortgage holder, if you have variable or fixed, or you're approaching mortgage renewal, what things should you be paying close attention to? Even if you're looking at possibly getting into the market for the first time or moving up, you definitely want to check out this episode, so stay tuned. Once again, thanks for stopping by. If you have not subscribed to the channel, consider subscribing. Hit that notification bell so you can stay up to date with everything that's happening in the mortgage and real estate marketplace. More importantly, I want to hear from you, our viewers, our clients, in the comment section below. What do you think is going to happen with the Bank of Canada? We're going to see more cuts to come. Let us know down there in the comment section. More importantly, like and share the video, but let's get right into it. Now, ultimately, this week we saw the Bank of Canada, as expected, cut an additional 0.25%, bringing that overnight lending rate from 2.75 down to 2.50%. Ultimately, that 0.25% also translates into savings for variable rate mortgage holders, especially because of the fact that now we saw that prime lending rate move from 4.95% down to 4.7%. And ultimately, for Canadians that have a variable rate mortgage or a product that is tied to that variable rate component, that prime lending rate, you're going to see additional savings. Now, not all variable rate mortgages, as we've discussed, are created equal. You have to keep that in mind. You're going to see some mortgages, especially those with the banks that have those adjustable products, their payments are going to readjust to reflect that discount. Now, ultimately, what it works out to is generally around $15 per every $100,000 mortgage. So, because we saw that cut, you're potentially going to see about a $15 reduction per every $100,000 of mortgage balance you have. And also, there's an estimate. If you have any particulars, if you want to find out how this is going to make or break you, those changes, ultimately look in the description box below. There's a link to our free app. You can download the app, play around with those numbers, look at what those potential discounts could be, what future discounts could look like as well. Now, ultimately, if you have a static payment variable, that means that your payments do not change when the Bank of Canada cuts. You're going to just see some realignment in those adjustments of interest and principal. Now, ultimately, at the end of the day, it's super important to understand a few different things, especially those that are looking at their mortgages. We have a lot of clients that have existing deals that are about to approach closing in the next couple of days, couple of weeks, even a month or so. The change that happened today doesn't necessarily mean that your fixed rate mortgage will ultimately change. Just because the Bank of Canada cut a 0.25% doesn't mean your 3.99 fixed rate mortgage is going to move down a 0.25%, right? That actually is not how it works. So we have to understand in simple terms, right? If you really want to look at it, and we've said this before, but I think it's important, especially as we potentially are looking at a few more rate cuts down the pipeline, maybe by the Bank of Canada, and additionally in the US, we have to understand how this plays out. So if we think about the Bank of Canada, when the governor of the Bank of Canada, Tiff Macklem, the governing council, Deputy Governor Carolyn Rogers, when they come out and they do these press conferences, you know, these particular changes move the needle for variable rate mortgage holders. The data sets that they're looking at are mostly impacting the economy, inflation, unemployment. You know, these are the metrics that move the needle for the Bank of Canada. And then in turn, that impacts the variable rate mortgages in a very simple nutshell. On the other hand, we have fixed rate mortgages. These fixed rate mortgages move on a different barometer. They move on the bond yields, they move on treasuries, they move on what's happening in Canada, US, and debt instruments. It is basically the picture of the Canadian deficit spending, for example, right? If we see more spending, well, then bond traders don't like that. If we see less spending, austerity, they like that. They like to see consistency. So there's two different measurements of how fixed and variable rate mortgages move, right? And the simplest thing that we've said on the channel is that if you want to see where fixed rate mortgages are heading, just pull up a 5-year Bank of Canada bond chart and you can sort of track that. When we were higher, over 3%, obviously fixed rates were much higher. As we start to see them pull back and sustain that, then we'll see the banks potentially translate that into lower fixed rate mortgages. Now, a lot of things on variable rate mortgages that we get questions on are, if I'm in a variable rate mortgage, yes, you can lock into a fixed rate mortgage. It's always possible to take a variable and go into a fixed. You can't go from a fixed into a variable. And just because the Bank of Canada cuts, once again, just because that prime lending rate went now down to 4.70%, let's say you had a variable rate mortgage that was at prime -1. So now prime being 4.70 minus 1%, right? For those who had that particular product or those that are maybe buying insured right now that are eligible for that product, you'd be at 3.70%. Now that doesn't mean that in, let's say, 6 months or a year, you can lock into 3.70%. It all depends on what you're locking into. The first, second, third, fourth, or fifth year, what that translates to in that fixed rate product, right? So if a 3-year fixed at that point is, let's just say 4% and you're at 3.70%, does it really make sense to lock in? And ultimately, this depends on your appetite for risk that we've talked about on our questions episode. But ultimately, just important to understand if you're selecting or thinking about taking a variable right now, you have to understand the risk options. So ultimately, we've talked about that in a previous episode. I'll add the card here for those who want to watch it after they've watched this video. But ultimately, what we need to really understand is the Canadian economy is not as resilient as we suspected. And once again, the Bank of Canada pointed to the lag as a particular point of reference, because this was one of the questions asked to the Governor Council near the end of the press conference saying, look, we know it takes about 12 to 18 months for these potential cuts to bleed into the economy. So we saw these rate cuts basically leading up into March of 2025. Then we saw a pause as we sort of got the economy to digest those cuts. And things obviously haven't really worked out too favorably. And yes, we do have tariff scares. Yes, we have all this additional uncertainty added into the equation because of the US tariffs. But we also have to understand inflation potentially could basically remain level right now because the Canadian Liberals, basically decided to, not retaliate with additional tariffs on the US, right? Ultimately, basically whatever we're bringing in, we're not going to tariff them. And that's around $21 billion of savings, which means that Canadians don't have to spend that much more on those products, which should translate to a more stable inflation picture. Now, once again, that's the ideology here. It should work on paper in theory. Ultimately, we still have tariffs on automotive and steel and other things. Those continue to be problematic. Now, the Bank of Canada also pointing to that even though inflation came in at 1.9%, core, medium, trim, those really, really important numbers still elevate around 3%, that things are running pretty level for what the Bank of Canada wants to see. I think these are great points. Obviously, many will argue GDP is in the can right now. It's pretty much very poor performance. A lot of that bolstering that we saw at the beginning, as I said, was front loaded by a lot of businesses trying to complete a lot of exporting before the tariffs. That's now gone to the wayside. Now the reality is set in. You have unemployment ticking up to 7.1%. Nationally here in Canada, obviously higher for youth unemployment. And depending on where you are in the country, obviously it could be worse or better. That is something to pay close attention to. We have obviously the entire picture of Canada not as resilient as it is in the US. So I do believe that if we continue to see the data roll out, we continue to see the US cut, bring their overnight lending rate, their basically funds rate down continuously, that we could see the Bank of Canada continue to cut into a worsening economy. And that basically has a couple things here to sort of point out. And this is how markets move, and ultimately you may or may not be aware, but ultimately when you cut a Bank of Canada policy or the Fed's fund rate, are you cutting into strength or are you cutting into weakness? And this can move the needle for the markets, this can move the needle for bonds, this can move the needle for many different components within an economy. So the real question is, do you think we're cutting here in Canada because we're cutting into strength, or do you think we're cutting into weakness? And ultimately, if we're cutting into weakness, will these cuts potentially avoid a recession, whether or not you think we are or are not in a recession? I want to hear from you in the comment section below. What do you think the Bank of Canada should not do? What do you think they are going to do in the next little while? Let me know in the comment section below. But until next week, thanks for stopping by, and we'll see you all next week.